Welcome back to the Behind the Well Show. I'm your host, Roger Abel. I've got Elias Randa with me today. Familiar face, but we also have Chris McNeil, who is part of our team in the Dallas-Fort Worth area.
Hey, yo.
Welcome to Iowa.
Thank you. Good morning, y'all.
Good morning.
How are you guys doing?
Good morning.
Good morning, guys.
Hey, Elias, you're done with football, right?
Yes.
If you would have got that championship game, would you be done?
Well, the Division I championship's coming up, but the Division III championship's already been played.
Okay. I couldn't remember.
Yeah, the actually one of the teams, they couldn't use us because Wisconsin River Falls played in the championship and we ref their second round game. So you're not going to ref the same team twice
In the playoffs?
Yeah, at least at the Division III level, they staff it that way. So when River Falls made the championship, our crew was no longer eligible to be the championship crew this year.
Right on.
Was it a good year? Did you have fun?
Yeah, I had a lot of fun, and it was fun seeing the championship team. Now, that was the first time I reffed the team that ended up winning the championship. So it was cool to see what it takes to be that good.
Right.
And they have one really good offensive line and two, a quarterback. I wouldn't be surprised if that kid's the best football player in Division III in the whole country. Their quarterback was amazing.
Really?
Yeah, he can throw the ball, can run the ball. I'm sure he's a good basketball player. He's probably one of those, he can probably bowl, he can probably throw darts, he could probably hit a home run. He's just very athletic.
Their quarterback?
The quarterback for River Falls, yeah. I'm kind of surprised he's not a D1 ball player, but
I was just thinking, he's
he will
probably going to hit the transfer portal, you know?
No, he's a senior.
Oh, is he really?
Yeah.
Oh, wow. Okay.
He could be
And
a
I don't
grad
know-
transfer, can't you? He could probably get another. Guys had like 6-7 years of eligibility.
Yeah, I guess
the
now
quarterback
people
for
play
Miami
college
has
until
been
they're
in college
30,
since
so.
2019, hasn't he?
Weren't we
Carson
talking about-
Beck?
Yeah.
Hasn't he been in college since 2019?
It's probably 6 years.
Yeah.
So I don't know if he has any eligibility left. I won't be that surprised if he gets some sort of tryout or look in the NFL, and so we'll see. I don't know that he's ultimately good enough to play quarterback, but he's just a good football player. So who knows if he gets a chance and a team's, hey, we could use you doing something.
Well,
you never know,
right? Or go receiver like Julian Edelman was quarterback in college. D2.
Yeah, for
He
like
went
Division
slot
II.
receiver.
Yeah, it can
you
happen.
know?
So
Yeah.
we'll see. I don't know.
Nice.
Well, with that said, we have a couple of listener questions. We don't get these too often, but when we do, we sure appreciate it, and we like to talk about it. So kind of nice. We have a panel discussion today. I'm going to let you guys do the heavy lifting. I'm going to throw the first question at you guys. Amy asks, how much does the average retiree have saved? I'm trying to figure out how much I realistically need to save. So here's what I think we should do. Break this into how much most people have saved. And then you guys kind of attack what you would do if you were Amy to figure out how to save what she needs.
So when you say, well, are we going off just what is in general the average, or
Yeah.
like what is the average of people who are actually financially independent and can stop working?
Well, that's a fair question. Let's go with people that are striving to be financially independent, because there is a subset of the population that's not their goal, and we know they don't have anything saved. But of those trying to be financially independent in retirement, and the goal is to retire kind of on their terms versus relying on the government, what do those average people have saved?
I think what's probably pretty standard and average would be anywhere from $1 to $3 million.
Okay.
I guess to me, there's some families that have more as far as just liquid net worth, but I'd say that's probably pretty standard for people retiring.
What's the national, what's the national average?
I think the national average is a lot less than that. Like
I
I'd
agree.
say it'd be closer to 250, 300,000 as like a national average from that aspect. Like $1 million to $3 million is probably going to be somebody that's a year or two from retirement. Like they've done a really good job saving. Like I think if you've got $1 million to $3 million,
I guess that's what that's
Right.
who I was thinking of.
Yeah, I mean, you've done a really good job saving, but yeah, I think the national average is probably closer to 250,000, and it might even be less than that
For people in their 60s.
Yeah.
Here's how I would respond to Amy if she asked. I mean, she did ask me this question. I don't think what the average has saved matters.
Right.
I think it's strictly a function of what are your future goals and priorities in retirement? And do you have saved what you need to have? And if not, how much do we need to save to get there? I think everybody looks at retirement, and it's ironic. We just got done doing a podcast for you on
You're Not
Dead Yet. So you can catch that too. But it was about pensions.
Mm-hmm.
Well, how much someone has saved is a function of what they need to have in retirement. So figuring it out shouldn't be like, how much money do I need? It should be, how much money do I have to save to generate income? And I think people mistakenly look at, well, if I have $1 million, I'll be okay. Well, yeah, if you live on $100,000 a year and you're going to get Social Security, you might be able to make it work.
Right.
But
$1 million today isn't what $1 million was 20 years ago, right?
Yeah,
like,
you have $1 million saved and you spend $15,000 to $20,000 a month. Okay,
yeah,
you spend $25,000 a month.
So, yeah, it's over.
Yeah,
it's gone. It's going to get 5 or 6 years. So it's not really what other people have done. I want everybody to stop thinking about what other people have done and get in the world of what do I need to do to put myself in a position to win.
100%. And it can be a very dangerous scenario to play the game of keeping up with the Joneses or doing what other people are doing. So it's what this tells me is that Amy hasn't had an opportunity to sit down with somebody to review goals and objectives and build out a plan based on, her goals to say exactly that. How much do you have to save, for what you think you're going to need in retirement? I mean, that would be step one.
One of the things we've actually done is we have our investor guide series on the website that you can go download a guide that will help walk you through what it looks like to think about retirement and break your spending into needs, wants, and wishes, which is in that guide. Mm-hmm. And that's really step one here for Amy is, Amy, what does retirement look like for you? And if you're 30 years old, not too young to do it, I get it. You don't know what retirement's going to be like, but just figure out how much do I need to be saving to replace my current income and then adjust it for inflation.
Right.
Most people don't, start at a job, stay within that job for 30 years and their income
stays the same.
It gradually goes up. They don't typically get to a place their income 10Xs and things drastically change, but that's why you have a plan that's adaptive at the same time.
Wealth building is not a contest, right? It's not a contest. It's a journey. Everyone's on their own path trying to figure it out. And I want to share something that I shared this with my kids the other day. Comparison is the thief of joy. So your wealth building journey should really just be like you guys are talking about your goals. Let's define what that is. What is it going to take for you to be financially independent? And really at the end of the day, it's for Amy, the most important decision is, do you want that to be a goal for you? I mean, there's a lot of people who haven't even decided that financial independence is something that's important to them. So the first step is if you do decide that, then let's figure out, well, what's your path going to look like? What is your journey to that? How can you accomplish it? Because there's no right or wrong way to do it. There's no perfect way to do it, but there is a way that will work for you. And there's a way you can do it that's in concert with your goals and values. And so the question of, well, how much, and I always hear you have to have, those are kind of difficult questions to answer because there's really no answer.
Right.
There's really just no answer for it. There's all these moving parts, and depends on the situation.
Well, the reason it's really important is when you figure out what you need to live on, a couple of things have to come to light. One, you have to figure out what your lifestyle expectations are. I mean, what are you trying to accomplish?
Beans and rice for me. Beans and rice.
But not for
rice
your family.
And beans.
New house for your family, bud.
Yeah, no, they get steak and lobster. I get beans and rice.
If that's what it takes to make it work, it is what it is.
Yeah.
But when you start to look at how much you need to be saving, you also have to start thinking about what income sources are you going to have when you retire. Mm-hmm. Are you fortunate to be at an employer that has a pension? Are you fortunate to have a good Social Security check? Do you have rental income from a portfolio? So when you don't just look at your money as a pile of money, you start to give it priority. You have to look at all of the other factors that are there. And there's other factors that I'm not mentioning that I'm sure you guys could think of.
Right. Well, I mean, I think you mentioned inflation earlier. I don't think a lot of people realize, the importance of outpacing inflation once you start taking income from the portfolio, because, you just look at the average inflation rate. If we just say it's 3%, your purchasing power over 10 years is going to be reduced by about 30 to 35%, and it's going to be cut in half over the next 15 to 20 years. So it's not just, do we have enough to retire today? It's, are we going to continue to have enough 15, 20, 25 years from now? And knowing what those expectations, and, retirement has 3 phases: the go-go phase, the slow-go phase, and the no-go phase.
So here's what's ironic about what you just said. You talked about inflation and how over time you have less to spend. And I've been doing this for 22 years. And here's the reality of how people spend money in retirement. And where in some cases, I believe there is a disconnect between the financial planning and the reality. And when we do the financial planning, we're indexing for inflation around 3% a year. And that basically says, well, you're going to get a raise in income of 3% a year. And over the course of 20 plus years doing this, very rarely, well, let me just say never, has someone come into this office consecutive years and say, hey, I want my 3% increase this year. They set up an ACH, go into their bank account for $5,000, and a decade later, they're still taking $5,000. So what's happening over time is their needs for money are decreasing because inflation's eating into it, but they're in the slow-go phase. They went from no-go to slow-go.
Right.
And I think that's one thing that you should be looking at when you're building a plan for somebody too. What's the reality of how people do this? And the only time I can remember in 20 plus years of doing this, that people made a conscious effort and came in here and said, hey, I need to increase my monthly amount, was 2022 and 2023. And it's because it's the first time we've seen really significant inflation that people weren't able to just gradually adjust to.
Right.
They saw stuff going up 10, 15. I mean, eggs doubled. I mean, we're talking about the egg index, whatever.
Right.
There's certain things that just were a shock to people and they literally needed more money. Homeowners insurance, taxes, all those things went up. But typically I don't see somebody come in here and ask for a raise every year. It just doesn't happen, which means they are spending money.
Right.
Spending less money.
Well, you're going to spend more in the first part of your retirement, right? The go-go phase. Like, that's when you're traveling. That's when you're doing all of the things that you dreamed of doing in retirement while you were working. But, that's going to slow down over time. So you're not going to spend the same amount. I think what becomes more of the primary cost in the no-go phase is more healthcare and things of that nature. I think that's where you see those, expenses increase and have to offset.
And it's pretty hard to
know what that's going to be.
Yeah, I mean, there's really no way. It could be, you could pass away of a heart attack at 87 and never need any type of extended care, or you could be there for a decade and need millions of dollars of extended care. So that's a really hard one to plan for.
Right. What's that saying? Hope for the best, plan for the worst.
That's one of, that's a saying, isn't it?
Right.
Yeah. So psychologically, what do you think causes, because that's an interesting point you bring up, when people don't give themselves like an inflation raise every year. Do you think it's just some of the reluctance to spend? Because people in general, when they retire, they are a little bit concerned or scared to start taking their money out and spending. So then once they have that set pattern, do you think it's uncomfortable to ask for more money? Or do you just think when you're living day to day, you just don't even notice that?
They don't even notice. It's like a job. I think it's Elias. It's almost like the person who does the 401k or participates in their company 401k for the first time. They were getting a check for $5,000 a month. And now it went down to $4,600.
Right.
So the first month or two, there was an adjustment period. But then eventually they match their lifestyle to the amount of money coming in. And they're to a point, the older you get, you're probably less concerned about increasing your lifestyle. Like, I typically don't see retirees who their desire is to increase their lifestyle.
Yeah, they're already
They're already doing what they
Yeah,
want to
they're
do.
dialed in. They
Like,
have their
maintain
routine.
it, but not increase
Yeah,
it.
Now-
they have their habits. Their
I will
routine.
tell you, retirees that tend to retire early, I have seen situations where I think they actually are trying to increase their lifestyle because they have a big pile of money and it's accessible, and it never was accessible. Their work. I don't see that with older people, but I have situations.
What's early? 55?
Yeah, I'd say like late 50s.
Yeah, okay.
Yeah, like they're spending more money now on things that they never would have bought before, like new car, more frequently getting new cars and all those different things that they didn't. That was never their pattern when they were working. But I typically don't see that with people who are over 65 years old. Typically, they're settled in; they're not going to change their spending. But younger retirees,
Yeah.
I still see.
So that
change
that
their
window
spending.
for more aggressive spending, it might even be shorter than kind of what we planned for. Like
Could
when
be.
you think of it in the light you just said, like mid to late 50s up to 65.
Yeah.
Huh.
I don't know. I always just kind
Hey,
of
you can't take it with you. I mean, you got to spend some of it too. Like your podcast, it's called "You're Not Dead
You're
Yet."
Not Dead
I
Yet.
mean, you got to spend
can't
some
take
of
it.
this money. You
Well,
can't
and if you think about
hitch
it,
it to a
they're
wagon.
Enjoy it while you can.
these are the first retirees with massive amounts of dollars saved because we've talked about it earlier. There were pensions.
Mhm.
All the pension, there was no pile of money, so you had to just adapt to what
Yeah, the onus is
your check was. Like you have to
on the
budget.
investor and the employee to say.
Yeah.
Yeah.
So now people are trying to navigate that, and they want to make sure they have a cushion, so they end up dying with a lot of money. That ends up going to beneficiaries. Whether good or bad, it just kind of is what it is. But let's move on. We have one more question. It's from Dale. We have about $180,000 sitting in savings because we're afraid to invest it at the wrong time. How do we decide when to put the money to work without regretting it? Common question. We get it all the time. Like,
And especially right now, this one's very popular.
Very timely.
Yeah.
with
Just
where we're
in
at.
conversation. And
I mean, it's any time, right? If the market had a 30% drop, they'd be asking the same question. Well, now is the time, or is it going to go down 10% more?
Mhm.
This is a common question all the time.
Yeah.
yeah,
I
actually-
would say what you need the 180,000 for. If it's sitting in savings,
Yeah.
like what do you need the 180,000 for? Is it for the down payment on a house 2 years from now? Is it, to buy a second home 5 years from now? Is it, what are the goals, for the money? And then, but you can't time the market, right? Like there's never been one person that's been successful at timing the market, because we say this all the time. You don't have to be right once, you have to be right twice.
It's statistically
There's-
impossible. The statistics are
Mhm.
0.0 with 213 zeros before the next number. That's your probability of consistently timing the market.
Right. So
there are
it's the
people
time
out
in the
there
market.
that will tell you they can do it. There's people out there that
No,
say
yeah,
they
no.
can do it.
Probably tell you the 401k is a scam too. Right there on TikTok.
Right. And that whole life insurance
Yeah,
is the only
I
thing you need to
know.
invest in for the rest of your
Right? I
life.
mean-
Yeah.
We'll put those people in
Hey,
the same light. Harry? Is Harry one of them? Haven't heard anything
Oh,
from him.
just all kind. There's a lot. I mean, whether it's people on the street, people that are more popular in finance, or even in the finance media, there are people out there that will tell you that they feel very confident in their ability to time the market.
I don't think they've ever compared their returns to another investment. Like they're happy. They think they're timing the market for their needs and they're happy
Yeah.
with it. They're managing volatility. Here's what everybody should take away. This question gets more common as we hit all-time highs in the stock market. Well, an all-time high in the stock market happens 27 times on average per year. So it's not a flaw of the stock market. It's a feature. Should be seen as one. We did a podcast last summer, Elias, and it talked about 10-year trailing when you invested at an all-time high in the stock market or you tried to buy the dip. And inherently, we all believe, hey, if you bought the dip, you would have been better. And that's not the number.
Mm.
That's not statistically accurate. I think Nationwide put that out. You're actually have a higher return profile 10 years later when you buy an all-time market high versus trying to buy the dip.
Yeah. What were the reasons for that?
I don't remember. I'm guessing I didn't dig too far in the weeds, but I'm guessing that has something to do with momentum. If you tried to buy the dip and it went down 5, it could have still went down another 20.
Mhm.
And that's what people try to do. They try to buy low because they've been told buy low, sell high. Well, just buy all the time and then sell high.
It's very
and figure out.
dependent on your entry. Right? Because if you time the bottom perfect,
but that's not a dip buyer. Dip buyer doesn't wait for the bottom; they wait for a dip. Like they see a 3 or a 5% downturn, like, oh, I got to buy. Well,
but then it goes down.
It could go down another 10 or 15. Where if you think about our market, I believe more than any time in the last 30 years, our market has a lot of momentum built into it. Meaning, once it starts going, it's going. And this goes back to the days when I used to trade the yield curve with treasury bonds. I always would tell you, if it's hard to buy something, it's probably a buy. And if it's easy to buy it, it's probably a sell. When the market goes down 5%, it's easier to buy it than it was when it was hitting all-time highs.
Yep.
Yeah.
And that's a little bit of a momentum play there.
And we have a market that's grinding higher.
Double-digit gains for the last 3 years in a row. Very rarely, historically, that fourth year have you seen double-digit gains. I mean, you've seen modest gains or a potential pullback. But, I mean, there's been, 4 times in the history of the market that we've had 3 years in a row of double-digit gains.
Well, and over probably the last trading year, the dips have been a little bit more shallow. Because people
we
are
had
coming
19 and a
in.
half this year. That I would say we had a big dip this year. It was 19.8.
Right.
Intraday,
Since
it went
then,
20, but never closed down 20. But intraday, we were down 20.
Yeah, since the tariff pullback or whatever people call
There really
it.
hasn't been one.
Right. The sell-offs have been pretty shallow.
Yeah, for sure.
And to Roger's point about it gets hard to buy, well, we have this market that's kind of just grinding higher. We have all this cash, and we know there's a lot of cash still in money markets and on the sideline. Well, how long are people going to sit out and watch it just kind of tick higher and tick higher and tick higher? Because at some point, I'm sure with the momentum and things like that, there's probably going to be some fear of missing out trading that starts to happen too.
Oh, I think
how long are you going to go with cash?
That's the scariest thing you could have is the fear of missing out, because then you're probably getting in at the exact wrong time. But I think time horizon,
that'll happen too.
Right? Time horizon is really what it comes down to. Is, if you've got 180,000 in savings, if you're going to need some of that money in the next year to 3 years, and we talk about this with our clients all the time. Look, that's not money we're putting in equities. That's not money that we're investing where if the market was to pull back 20%, which is the bear market, that we're going to use for those goals. And then you use that money, invest it conservatively, so you're not participating in that 20% pullback, but then a portion of the portfolio that's longer term, our growth bucket, 7+ years, that's where we're going to take the risk and be in equity. So if we do have the 20% pullback, you've got 7+ years for the market to recover plus some before you need to tap into it for income or for your goals.
Yeah, there's just too many people waiting for that right now. There's
high
too many
cash
people
balances.
waiting for that.
There's another reason people have high cash balances. They were getting 5% on their cash. It was easy to park it in cash when you could go to the bank and park it at 5+%.
And
those days are over.
Yeah, those
they're
are
in their
gone.
threes, right? And they're going to keep clicking down.
Yeah.
And now they're like, man, maybe I should do something different. But now the market is exponentially went up. They're like, man, it's too high to buy it now. Well, where do you think it's going over the next 15 years? The worst 15-year return is like 5.77% on average. So that's still better whenever it's due in the bank.
Right.
But I think to Chris's point, the best way to do this, start assigning responsibility. So make sure you have 6 months of an emergency fund slashed away. None of this other money's earmarked. Then you got to start to put some of it to work.
Right.
Because eventually the interest at the bank is going to be outweighed by inflation. There's really no benefit.
I call it lazy money. And if you've got your 6 months of emergency savings in place for that what if scenario, anything above that is lazy money if you don't have it invested in some form or fashion outside
I like
cash.
that. I like that.
That's lazy money.
Do you know what Jonas calls it?
What's he?
Spare
But
tire.
we
The
have
spare
we
tire?
have extra spare tire.
Oh, okay. All right.
And haystacks
So we have
and needles.
We have two ways to talk about
Lazy money.
Right.
extra cash beyond emergency fund. Lazy money.
Lazy money.
Extra
Anything
spare
past that six. And some people are more comfortable if they have a year of monthly expenses saved up. But anything realistically past 6 months, and again, it's not investing it in the NASDAQ or investing it in some speculative stock. But, there's ways to invest that based on time horizon where you can earn more than what you're earning in cash right now.
Yeah, you could. That's a good point. If you had 180,000, you needed 90 for your emergency fund.
Then you're not investing 180. You're
Yeah, the other 90.
But 90 is lazy money if you're not investing it.
But there are assets you can make better than that bank that don't involve high-tech stock type risk that you could juice your return. And that's really what it's about, is how do we get a little bit more incremental return from our lowest producing assets over time.
Risk tolerance too. I mean, we don't call it risk tolerance. We call it risk capacity.
Yeah. How much risk do you need
How much risk do you need to take to meet the goals and objectives that you have in place?
Yeah, that's great.
Yeah.
Well, with that said, I want to thank everybody for watching the show today. We're happy to have Chris McNeil here with us from Dallas, Texas. I want to tell him what city you live in. I don't even know, really.
It's a DFW Metroplex.
Yeah, okay.
Kind of centrally located.
Yeah. Right on.
If you watch the You're Not Dead Yet, you know what city I am because of youth football and coaching and all that stuff. So.
Nice. Well, maybe they'll catch it. Elias,
tap in.
Thanks for your update on football for this show. Appreciate it.
Yeah.
No problem. Happy to be here.
If you enjoy the show, do us a favor. Make sure to subscribe on the platforms we're on. Send us a question if you want it answered on air. We really do enjoy answering the questions, as if you have it, somebody else probably has the same question as you. With that said, I want to thank everybody for listening and hope you have a great 2026.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments and Wealth Management and LPL Financial do not provide tax advice. Please consult your tax professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. Dollar cost averaging involves continuous investment in securities regardless of fluctuations in price levels. Investors should consider their ability to continue purchasing through periods of low price levels. Such a plan does not assure a profit and does not protect against loss in declining markets. A plan participant leaving an employer typically has 4 options and may engage in a combination of these options, each choice offering advantages and disadvantages. Those options include leave the money in their former employer's plan if permitted, roll over the assets to their new employer's plan if one is available and rollovers are permitted, roll over to an IRA, or cash out the account value. Consult your tax professional about eligibility to Roth and traditional IRA contributions. Contributions and earnings in a Roth IRA can be withdrawn without paying taxes and penalties if the account owner is at least 59.5 and has held their Roth IRA for at least 5 years. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of the conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA.